a snapshot, as of 2015, of the footprint of Pan-African banks in sub-Saharan Africa. You can see that the share of total particularly the case in the southern and western African region. The expansion of Pan-African banks has been rapid and has accelerated following the global financial crisis. Between 2016 and 2014, the number of subsidiaries of the largest 14 banking groups have more than tripled. What are the factors behind this very rapid acceleration? Following the global financial crisis, a number of favorable factors have converged, including improved economic and political conditions in the region and the retrenchment of lenders from advanced economy. It must be noted that the driver of Pan-African bank expansion associated with improved economic conditions has weakened starting with 2014, and this has been reflected in a deceleration of the growth of Pan-African banks in the region, such as that between 2014 and 2015, the expansion has almost stalled, with only one additional subsidiary open in the region. Let's now have a look at the modality of expansion of Pan-African Bank. Banks have expanded mainly in the form of independently managed subsidiaries, where with independently managed, I mean that subsidiaries are independent from the parent in terms of funding and capitalization. The chart illustrates the case of banking sector, banking groups, with a quarter in Nigeria and South Africa. You can notice that the interbank exposure between parent and subsidiaries is limited, and in most of the cases is directed from host to home. This reflects the fact that Pan-African banks have subsidiaries fund themselves domestically and transfer excess liquidity in the parent bank. This is important because it suggests that subsidiaries of Pan-African banks might be protected from direct contagion effects that usually take the form of a freeze in interbank lending or a freeze in direct cross-border lending, both of which are very limited in the sub-Saharan African region. However, local banking sector remain exposed to the possibility of indirect contagion effects that usually materialize in the form of loss of confidence in the brand name or in the form of fire sales of shares of subsidiaries when there are losses in some other that originated in some other part of the network. Another important feature of a cross-border banking structure is the network structure. In the case of sub-Saharan Africa, network structures are not homogeneous, and they range between structure with a dominant parent and structure dominated by systemically important subsidiaries, with a variety of structure in between. The case in this chart, we see the case of Stanbic Bank and EcoBank Transactional Incorporated that have a contrasting network structure. On a side, Stanbic has we have to correct AIT, instead is ATI. So we have a contrasting banking structure where Stanbic has a dominant parent and a constellation of smaller subsidiaries, while EcoBank Transactional Incorporated has a dominant, as a network dominated by systemically important subsidiaries, of which the most important is by far Nigeria. You can notice that is why we are interested in a network structure. The reason is that network structure are important for the transmission of shocks. How that is, they affect how shocks are transmitted within the network. But network structures are also relevant for the management of consolidated supervision. Indeed, consolidated supervision by the home country can be complicated when network structures are dominated by subsidiaries that are outside of the home country. In this case, the coordination and sharing of information between home and host and must be particularly intense and needs to be performed on an ongoing basis in order to ensure an effective consolidated supervision. Let me now give the floor to my colleague Bosena. Much? Much longer. Of what? I don't know, I didn't count.
How many slides altogether was that? Okay. Here's the problem. Slides are very, very difficult to read from the floor, so I would suggest that you do a little less of, as you can see. Okay, just talk to the topic. Because, for example, at the very beginning where you said something about 40%, and I looked at the screen and
you couldn't see anything, yeah.
I actually already talked to the technicians about if there's anything to make the slide larger.
So what are the benefits and risks of rapidly expanding Pan-African banks? Let me first focus on the potential benefits. There are 5 which I would like to mention. They facilitate financial and economic integration in the region. They transfer know-how, skills, expertise. Daniela, I can't, sorry, I mean, either we run or... No, you forget, but you know.
Can you put it on? Okay, thank you so much. I think I will be introduced by Anne-Marie, okay? So, thank you very much, Anne-Marie, and good afternoon, everybody. In the next 15 minutes, together with my colleague Bosena, we will illustrate some key facts on the expansion of Pan-African banks, and we will highlight which are the potential benefits and challenges associated with this expansion. I will start with a few relevant facts on the expansion of Pan-African banks. First of all, I would like to explain why we focus on Pan-African banks. The reason is that Pan-African banks have become systemically relevant in a number of countries in the sub-Saharan African region, as highlighted by the managing director in the keynote address. In this chart, you see the share of total deposits of the 14 largest Pan-African banking groups. It's evident that Pan-African banks have a widespread footprint in the region and that in a number of countries have become dominant. This is particularly the case in the West Africa and Southern Africa region. The expansion of Pan-African Bank has been rapid and accelerated following the global financial crisis. Between 2006 and 2014, the number of subsidiaries of the 14 largest groups has more than tripled. Which are the drivers of this very fast expansion, of this acceleration? This reflects a combination of factors, both endogenous and exogenous to the region, of which particularly important are favorable economic and political conditions in most of the sub-Saharan African countries, and the retrenchment of foreign lenders that traditionally were providing financial services to the region. Starting with 2014, the expansion of Pan-African banks has decelerated. And this reflects the fact that one of the key drivers of expansion, the favorable economic condition, has weakened. About the modality of expansion of Pan-African banks, this has taken the form of independently managed subsidiaries. What I mean with independently managed is that subsidiaries are mainly independent from the parent in terms of funding and capitalization. In this chart is illustrated the case of Pan-African banking groups with headquarters in Nigeria and South Africa. It is evident that the interbank exposure is in most of the cases limited, and it moves from host to home. This reflects the fact that Pan-African banks, that subsidiaries of Pan-African banks fund themselves domestically and transfer excess liquidity in the parent bank. Why is this feature relevant? This feature is relevant because it suggests that Pan-African banks might be protected from direct contagion effects, where direct contagion effects take the contagion, I know, direct contagion effects, I knew it. Direct contagion effects, because direct contagion effects, according to empirical evidence, usually take the form of a freeze in interbank lending or a freeze in direct cross-border lending, both of which are very limited in the sub-Saharan African region. However, local banking sector remain exposed to the possibility of indirect contagion effects, which usually manifest in the form of a loss of confidence in the brand name, or in the form of fire sales of shares of subsidiaries due to losses in some other part of the group. I will conclude this part with a few words on the network structures. Network structure are not homogeneous in sub-Saharan Africa groups, banking groups, ranging from networks dominated by a parent to networks dominated by systemically important subsidiaries, with a variety of different structure in between. In this chart, we see the cases of Stanbic Bank and EcoBank Transactional Incorporated, the two largest banking groups in the sub-Saharan African region. These two banks have a contrasting network structure. Stanbic has a structure dominated by the parent with a constellation of smaller subsidiaries, while ETI has a network dominated by systemically important subsidiaries, of which Nigeria is by far the largest. Why the network structure is relevant? It's relevant for two reasons. The first is that network structure affect how the shock are transmitted inside the network. The second is because network structure is relevant for the management of consolidated supervision. Consolidated supervision by the home country, indeed, is complicated when the systemic entity is located outside of the home country. In this case, the cooperation and sharing of information between home and host supervisor becomes extremely relevant and should be conducted on an ongoing basis. I will leave now the floor to Bosena that will...
Good. Concentrate on speaking slowly.
Slowly.
Sometimes you get going fast and your words sort of blend together.
Okay.
Just think of a how do I say this? Of pacing yourself a little slower than you would speak conversationally. Okay. Are you working with a text? Do you have something written down?
I have written down, but I will read.
No, what I was going to say was this. Let's make photocopies of your certificates and give them to the interpreters so they have something in front of them to follow while we're talking, because they part of the structure of the state.
It is another, it's the same,
Yeah, it's not as bad there.
it's not as bad.
Yeah, so I think those things is have security things, have personal harm, and all that.
Yeah.
She says thank you very much.
And then she walks out and then,
she
you know,
likes
and that's why I thought, you know, maybe just take those gold steps and force everybody to come
You know,
this way.
but there are a few points where you I hear you.
But we could be, it's not only her, I mean, you know, we don't want one of the CEOs to break that.
Unfortunately, there's
Or we could,
yeah,
I guess,
it's open. You can't do it.
and the lectern can't be moved either, because if you were to move that a bit further, then, you know, psychologically,
Yeah.
or they could put a flower bit there. One of those.
Just to see the height of Madame.
Yes. Hi, everybody. Hi in Washington. Let's wait until actually I can get the event manager. We can talk about maybe putting something right there.
If there was another flower thing like that,
Yeah,
it would
the-
look good, and it
The
would
problem is
psychologically-
with this, we'd have to put it on the stage right here.
Yeah.
So let me just talk about that. Do you still need me to be here? Okay? Good.
So that I know the ranges of persons.
Is that one of the big ones or one of the small ones? Good. Let's just see how it looks. That won't stop them. I was wondering if we put it right there, how it would look. See, that will then make it safe. I think it's okay, but I think we need to talk, we need to let Effie know that we're doing it as well.
1, 2, essaie. Test. 1, 2. 2.
Hello. Mesdames, Messieurs les gouverneurs, Mesdames, Messieurs les directeurs exécutifs, Mesdames, Messieurs les directeurs généraux des banques, chères participantes, chers participants, en vos rangs, grades et qualités, soyez la bienvenue. Au nom des organisateurs, le Fonds monétaire international, l'initiative Making Finance Work for Africa et le comité de Bâle sur la supervision bancaire. Please note that simultaneous translation is available in French on Channel 2 and in English on Channel 1. To start this conference, I would like first to invite Madame Christine Lagarde and Governor Basant Rai to come to the podium. Thank you.
Managing Director of the IMF, Madame Christine Lagarde, Chairman of the Basel Committee on Banking Supervision, Mr. Stefan Ingves, fellow governors, executive directors, and senior officials of the IMF, distinguished guests, ladies and gentlemen, good afternoon. I'm pleased to welcome you all to Mauritius. I wish you a pleasant stay with us. I thank the organizers of the joint IMF BCBS Making Finance Work for Africa conference for inviting me to give the opening address today. May I extend my appreciation to the Mauritius IMF Africa Training Institute for hosting this conference. When I was here recently, I was asked to give a closing address to a house-full audience of course participants. I had shared with them my personal experience as a regulator of all deposit-taking institutions in Mauritius, while narrating to them a number of enlightening anecdotes related to events leading to the revocation of banking licenses, problems associated with crisis resolution, and presenting them with the risks and challenges that regulators face in the globalized world. I read in their looks the enthusiasm and the eagerness to take their regulatory and supervisory responsibilities seriously. Interestingly, I found out that regulators in Africa are keen to have better regulatory structures. Understandably, one hampering factor, apart from an acute shortage of highly skilled and seasoned bank examiners, that overwhelms all other considerations is national interest as opposed to the soundness and stability of financial industries at the regional, Pan-African, or global level. The political will is thus seen to be missing. It's a problem not confined to Africa only. I believe that it's in order for me to give a very quick and broad brush stroke of our experience with the regulation and supervision of banking and cross-border banking activities. Mauritius was a regional hub for payments and settlements in the 17th century. Traders from the West, the Middle East, India, China, crossing this part of the world, used to regularly meet here in Mauritius for purposes of payments and settlements. The US dollar, Portuguese and Spanish currencies, Indian rupee, pound sterling, gold, and silver used to be the means of payments and settlements. A characteristic feature of the hub was free banking. There was no regulatory authority and therefore no licensing authority. Banks used to issue their own paper currencies. And of course, bank failures were a common feature. The seed of frequent bank failures resided mostly in the recklessness with which banks issued their respective banknotes. The authorities' anxiety with regard to the sustenance of confidence and stability in the then monetary system had led to the setting up of the Board of Commissioners of Currency in 1864, the first in the world. By the end of the 19th century, the hub had lost its significance. Rivalries between bankers had led to the establishment in 1838 of what is today the largest domestic bank in Mauritius. Two British banks having large cross-border banking activities the world over have been present in Mauritius for more than a century. Soon after World War II, it was realized that our financial system needed to be regulated. Licensing of banks was introduced to prevent banks from collapsing due to stresses and strains caused by massive repatriation of funds. Exchange control was introduced in 1951. Ever since the establishment of the Board of Commissioners of Currency, a running thread of preoccupying concern has been the soundness and stability of our financial system. Regulation and supervision of banks started formally in the very early 1970s. Of the 8 banks then in operation, 5 were branches of international banks. A mix of home-host country regulations guided their operations. In the first half of the 1980s, we initiated steps to gradually liberalize our financial sector. In 1989, we established the Offshore Banking Center. 2 types of banking licenses were issued, one for banks carrying out exclusively offshore banking business, and the other for carrying out domestic banking business. By July 1994, with the suspension of our Exchange Control Act, the gradual liberalization of the financial sector was completed. The heightened pace of globalization and financial integration posed serious challenges for the banks operating in Mauritius and for us as the regulator. Admittedly, like other regulators in many jurisdictions, we were not prepared for the challenges. Subsequently, banks operating in the offshore sector were brought within the purview of more or less the same regulatory and supervisory norms as those applicable to domestic banks. The dual licensing regime was done away with. One of the most meaningful developments, yet unrecognized, in the Mauritian economy over the last 27 years has been the introduction in 2004 of a single license regime for banks operating in our jurisdiction. It allowed what formerly were offshore banks to interact actively with the domestic money and forex markets and with the domestic economy in general. Cross-border banking activities decisively picked up. The Bank of Mauritius Act and the Banking Act were both overhauled and suitably recast to meet emerging regulatory challenges. Previously, quite some prudential norms set by the Bank of Mauritius used to be introduced by way of regulations made by the Minister of Finance. They sometimes used to be lobbied against in the halls of government. by making the guidelines legal in the Bank of Mauritius Act 2004, the bank today does not have to have recourse to government for issuing guidelines to banks, and is therefore free from pressures from the banking industry and other related parties. So far, the Bank of Mauritius has issued 35 guidelines to the banking industry. They all have legal authority. As the financial integration accelerated, cross-border banking activities also accelerated in the 1990s. Today, cross-border banking activities account for 60% of our banking industry's businesses. Total banking assets are around 300% of our GDP. The risks and vulnerabilities to our financial industry and the economy are by no means negligible. Since the beginning of the new millennium, the Bank of Mauritius took a number of regulatory and supervisory initiatives, a few of which are as follows. 1. The bank entered into MOUs on cross-border supervision and information sharing with 16 of its counterparts. The MOUs set forth a statement of intent between the bank and its counterparts to establish a framework for mutual assistance, cooperation, and exchange of information in the fulfillment of the institution's respective supervisory responsibilities. 2. The Banking Act allows for cross-border cooperation in terms of group audit from parent bank of the subsidiaries and branches of foreign banks in Mauritius. 3. Besides carrying out on-site examination of overseas subsidiaries of local banks, the bank has also engaged with its foreign counterparts to carry out joint examinations of entities falling under its purview. The Banking Act allows host supervisors to conduct examinations of banks in our jurisdictions. 4. 2 years ago, a huge financial conglomerate failed in Mauritius. The Bank of Mauritius Act and the Banking Act were amended to enhance both consolidated and conglomerate supervision. 5. The Bank of Mauritius attends to supervisory colleges of almost all the subsidiaries and branches of foreign banks operating in our jurisdiction. The bank has a policy of holding supervisory colleges for the two largest domestic banks that have subsidiaries and branches overseas. 6. A major risk associated with cross-border operations is money laundering. The Bank of Mauritius has continuously upgraded its guidelines on AML-CFT in line with FATF recommendations. Strict enforcement of the guidelines has led to severe regulatory sanctions against non-compliant institutions, which explains why the bank is so unpopular. And 7, given the acceleration of cross-border banking activities, the Bank of Mauritius is currently strengthening its risk-based supervisory framework. And we are thankful to the Managing Director of the IMF for having provided due assistance to us. These initiatives are by no means adequate for effective regulation and supervision of our banking industry. A lot more has to be accomplished. At some point in time this year, we would be having a crisis resolution framework for Mauritius. Crisis avoidance, more so in an increasingly digitalized financial world, requires far bolder initiatives to strengthen regulatory and supervisory frameworks, not only in Mauritius, but in every other country in the African continent. We are told that in the years ahead we will continue to be provided with banking and financial services, but banks as we know them today will no longer exist. We, regulators, have to be steps ahead. Our regulatory and supervisory experience clearly demonstrates that effective regulatory structures for cross-border banking activities are indispensably needed. The absence of a regional or Pan-African regulatory structure is palpably felt for quite some years. The idea, mooted already, of having a regulatory structure for overseeing banks having significant cross-border banking activities does hold water. This could be a starting point. Regulatory challenges keep multiplying on the regulator's desk. For instance, we at the Bank of Mauritius, we observe in our jurisdiction here that the distinction between subsidiaries and branches are blurring. Instead of being incorporated locally as completely separate legal entities, subsidiaries of big banking groups are being organized along business lines. Different subsidiaries of the same banking groups are being set up in different jurisdictions with different facilities and advantages. Would a failure of one of those subsidiaries not bring down the entire group? Ladies and gentlemen, there is a multiplicity of complex regulatory issues that need to be resolved by governments and regulatory authorities in the African continent. I do not wish to preempt the panelists. We have the distinguished presence of seasoned regulators as panelists for this conference. I'm confident that we will leave this place with a lot of ideas and options to contemplate about. May I thank the Managing Director of the IMF, Madame Christine Lagarde, and Chairman of the Basel Committee on Banking Supervision, Mr. Stéphane Ingbes, for being with us during the conference. I once again thank the Director of IMF Africa Training Institute for hosting this conference. Thank you. May I now invite the Managing Director of the IMF, Madame Christine Lagarde, to deliver her keynote address.
Well, thank you so much, Governor Bassan Roy. Bonjour à tous. C'est un plaisir d'être à Maurice et c'est un plaisir d'être accueilli par un speech d'une telle qualité qui couvre autant de sujets, Monsieur le Gouverneur. Je pense que vous nous coupez un peu tous l'herbe sous le pied maintenant. And I have no idea how to translate how you cut grass under my feet, but that's the idea, essentially. You've covered it. So thank you for your kind words of welcome to all of us. I would like to celebrate on our behalf all of those of us here who are not from Mauritius, this very special day which marks the 166th anniversary of the abolition of slavery on this island. We're very grateful that those of you from Mauritius who had a public holiday today have ventured to actually come to this conference to take a little break away from this celebration. So, good afternoon to all of you, and thank you to all of you for some traveling very far today to join the conference, and thank you for those of you who will be panelists in the course of this afternoon and tomorrow morning, and for bringing you knowledge, your wisdom, and being prepared to share all of that with colleagues. We're certainly up to a good start with you, Governor. I would like to thank our co-sponsors, the Basel Committee on Banking Supervision. Thank you very much, Stephen, for coming all the way from a slightly colder country. It's not a bad time of the year to actually travel to Mauritius, I have to say. And Thank you also to Making Finance Work for Africa for co-sponsoring with us this conference. By teaming up, I think we emphasize the rapid expansion of cross-border banking in Africa, and we highlight the common issues facing banking supervisors around the world, not just in Africa. I would also like to express my thanks and offer my congratulations for the members of the Africa Training Institute who have been working really hard to make this event a success. Thank you so much to the whole team. Thank you to members of the African Department, of the MCM Department, of all those who are here today, but also those who are back at home in Washington and who've worked hard to bring us all together and make sure that we would learn something and we would take advantage of each other's knowledge and experience. I think this institute, and I'm here talking about the one that is not mentioned here, except at the bottom here, but the Africa Training Institute, is a testament to the deep commitment to Africa of the fund and the government of Mauritius. The government of Mauritius since 2013 has actually made facilities available, has contributed, has supported the Africa Training Institute, and I know that many of your officials have actually had the benefit of training sessions in this institute. Every year, ever since I've become managing director of the IMF back in 2011, I managed to travel to several African countries once or twice a year. And I say on purpose, I'm not traveling to Africa, because Africa is not one country. It's a continent, but it's many, many different countries. Very diverse, at different stages of development, with different cultures, different languages, different history as well. And everywhere I'm really amazed by the energy, the vitality, the diversity that is embodied by most of the countries, whether they have faced hardship recently and are therefore fragile, whether they are thriving in their development. Wherever they are situated in that process, there is that level of energy and enthusiasm for developing the economy. And wherever I go, I'm amazed by the startups, the developing businesses, the infrastructure developments that is taking place, and the growing middle class as well. And I have the honor when I do those trips to meet with all sorts of people from all walks of life who are trying to build a better future for themselves and also for their countries. They share a vision of a development that is based on strong, sustainable, and hopefully inclusive growth. And all of that would not happen if it was not for a financial sector that can actually safely and securely move money around and extend finances where finances is needed. Now, I know that all the countries that you all come from share this same hope and purpose of development for the better being of their populations, and that all of you actually want to develop that safe, secure, and thriving financial system that moves money around safely for the benefit of development. Now, since the financial crisis back in 2008, Pan-African banks and other institutions have become key features of the continent's financial landscape. We are seeing major development as we speak. And there are one more piece of evidence of the region's dynamic changes that I just described. What has precipitated that change? Well, clearly the growth that we have observed in the last 10 years, but also, and it's an interesting factor, the retrenchment of some of the international banks that used to be present in many of the African countries, and which, for reasons of their own, which have to do with de-risking, particular set of regulations applicable on a cross-border basis and required by the home country of some of them, or simply the cost-benefit analysis that they conduct for their own purposes. And that has led them to either have retrenching, or being in the process of doing so. And while this is regrettable in many ways, it has also opened opportunities, and the gap that they are in the process of leaving behind is actually filled by institutions that are taking their stead. These institutions, including many that are participating in this conference, representatives of the private sector, have filled the gap left since the crisis. They have supported the growth of individual countries with better products, better services. They have advanced economic integration and helped foster financial inclusion. They have also been sometimes champions and pioneers in the use of new technologies, including disruptive technologies. Let's consider for a second the development of mobile banking. I see here the governor of the Central Bank of Kenya, which has clearly led the charge on that particular front. Now, these are clearly important advances that can offer lessons to the world, not just amongst African countries, but to the world at large. Because all over the world, these advances present central bankers and supervisors with new challenges. Now, we have been talking about shadow banking extensively, and it is an important factor. But when we will be considering the use of blockchain technology, for instance, or the combination of telecommunication regulation and banking regulations together, there are lots of things that the African governors of central banks can actually teach the world. Vigilance and cooperation will be needed to ensure stability and resilience. The growth of Pan-African banks come at a time of regulatory change worldwide. These reforms, spurred by the 2008 crisis, aim at building stronger defenses against future crises. But they have not necessarily embedded and included in their thinking all changes that are taking place on the ground. Much of the work to preserve financial stability falls to the group that is assembled right here today. The new regulatory demands require your resources and your skills, and you are asked to achieve unprecedented cooperation with other African supervisors, with other supervisors in other places around the world, and yet, and legitimately so, you are concerned about adjusting to the local circumstances. And you face that delicate balance between enhancing regulation and supervision, improving cooperation, and taking into account those local circumstances. Should we have two sets of standards? Probably not. Should there be the room and space to actually adjust? Probably so, but this is certainly one of the areas that you will be exploring in the panel discussions. Now, you are not alone in this exercise, and we at the IMF are trying to represent all our member countries, 189 of them, not only some of the few, but all countries. And today what I will try to do is delve into some of the issues that you face with a focus on the supervisory challenges of Pan-African countries in the international context that we all face, and the role that the IMF can actually play to support you. Very quickly, I promise. So let's begin with the regulatory challenges as we see them. As bankers and bank supervisors, you understand the potential vulnerabilities that current slow global and regional growth presents. The changes in Africa's financial sector landscape over the past decade call for added vigilance. As someone famously said, when the tide goes away, those who don't have their swimming costume on are quite embarrassed. The expansion of cross-border banking has been impressive. 10 African banks now have a presence in at least 10 countries on the continent, and one African bank is present in more than 30 countries. This expansion inevitably has brought a host of new complexities, with varying regulatory regimes across countries at different stages of financial sector development. it should not be surprising that effective oversight of cross-border banking presents immense challenges. Unified accounting and reporting standards are absent. Data weaknesses abound. National secrecy laws and constraints on information flows impair cooperation among supervisors in home and host countries. Now, Stephen, I'm tempted to turn to you, because as I was writing this, I was thinking to myself, 15 years ago, we could have applied exactly the same issues in relation to European banking system. I see both of you nodding over there. Now, the key is also to ensure that supervision takes place on a consolidated basis. Bank holding companies are headquartered in one country and have subsidiaries across the region that operate under their host rules and regulations. And you're right, Governor, there is a blurring of the line between branches and subsidiaries are conveniently divided into various subsidiaries in various countries where the rules eventually are different. And this places an enormous burden on supervisors who have primary oversight of the holding companies. It is also essential that host countries are informed and consulted, and for host country supervisors to be involved. And I know, for having lived through the financial crisis myself as finance minister, that it's not only a question of regulation, it's not only a question of implementation, it's often a question of personal relationship and the ability of all of us, some of us, to have the humility to accept that everybody else is going to matter in the process. Now, we know that resolution frameworks and mechanisms are insufficient in any number of countries, let alone on a regional basis. By the way, again under your control, Stephen, because you are far more advanced than me now, but the resolution mechanism, particularly on a cross-border basis, is probably the ultimate graal that is so difficult to attain, isn't it? Yeah. Now, I know that each and every central banker, supervisor, and bank executive in this room is deeply aware of all the issues that I have mentioned. And you have taken important actions already. Several of you who are home to Pan-African bank groups have established supervisory colleges. And this allows you and supervisors in host countries to conduct more comprehensive assessment of risks at individual institutions. Home supervisors need to ensure that supervisory colleges work well and that host countries are informed and regularly consulted. Host supervisors, on the other hand, need to be active in this collaborative process as well. Home supervisors need to be aware of how their decisions are going to affect the host country, particularly when the host country is a smaller country. Now, it is also good, in addition to those supervisory colleges that you've established in many instances, to see that the countries of East Africa have provided a model for harmonizing supervisory data and practices as part of their effort to create an integrated economic community. These are welcome development. The challenge is to build on the success in countries where steps have already been taken and to try to extend throughout on a sub-Saharan basis. Let's now have a quick look at the international context. Because clearly, cross-border issues are not just an African issue. It's now a decade after the global crisis, and yet financial sectors remain fragile around the world. And the reform agenda that was started, which has proven to be ambitious, is still not completed and may never be completed. And I'll come to that at the end of my remarks. This effort is more advanced in other regions, although it remains incomplete. Nonetheless, reforms by the European Union, the UK, and the US can provide valuable guidance for Africa. We know that we learn from our mistakes, but wouldn't it be helpful if we could all learn from other people's mistakes? And that's the whole point of trying to understand what may have caused great difficulties in the process and what steps have been taken. The fund has contributed time and energy to this effort. In addition, the Basel Committee's work on consolidated supervision and the Joint Forum's work on supervision of financial conglomerates have been very important. That's why I'm so happy that you're here, Governor Ingves. You will tell us not just about the work that you're doing now, but also the work that you used to do dealing with the Nordic experiences way back. And I know that you will have a fuller discussion at panel level on these issues. What I would like to do is to touch on some of the takeaways from the work that has been done since 2008. But before I get to that, and I'll only touch on 3 points, I would just like to make a point about bank supervisors. They are on the front lines in an era of rapid change in the banking industry. Their work requires both sufficient resources and political support. Because it's always easy and tempting to lower the bar of supervision, particularly when policymakers are worried about economic growth and when banks face pressure to expand credit or to provide a solid return to their shareholders. But if we ease up at our perils. These are certainly lessons from the recent experience in the US and in Europe, in terms of both the adequacy of regulation and the commitment to supervision. So let me highlight 3 of those. And for some of them, I've actually lived through them, as some of you have. I can think of Julie, Stephen, and representative of the Bank of England as well. First, you remember too big to fail, too big to manage? Certainly one first learning is the issue of the complex institutions, including cross-border financial groups. They require enhanced regulatory and supervisory framework. As was shown during the crisis, supervisors failed to understand the risk profiles of cross-border institutions. Not deliberately, not because they were of bad faith, but these entities built up complicated market positions, shifted business across borders, and became just too large to manage. I'll take 3 examples. Royal Bank of Scotland was certainly one. Lehman Brothers, famously. And in the non-bank arena, AIG. Regulation and supervision failed to keep pace. What this means for Africa is that prudential rules affecting capital and liquidity requirements need to match the risks found in a bank group. This requires sharing more information among supervisors. It also means that supervisors need the power and the confidence to do their job, including by challenging bank management, as you just recently referred to, Mr. Governor. The second lesson is something I have already touched on: the importance of cooperation among supervisors in identifying and addressing risks in cross-border banks. For example, stronger cross-border dialogue could have helped spot the buildup of risks in Icelandic banks, or in Irish banks for that matter, including massive imbalances between assets in Iceland and deposit and other liabilities outside the country. Experience in Iceland and elsewhere points to the need for effective supervisory colleges that proactively discuss emerging risks and the appropriate responses. Third, experience tells us that there will be times when all of these efforts will be insufficient. So what can we do then? Use taxpayers' money? Certainly not the right approach. So to sustain the banking systems, what can be done? Well, what is essential is to actually put in place robust frameworks for the resolution of cross-border institutions that give regulators the authority to close banks, not banks. Supervisors need to be able to work across borders, preferably on weekend, as we were discussing last night, Mr. Governor, in order to develop practical resolution and recovery plans. It is not an easy thing to do, but it is clear that trust and cooperation must be built during normal times. Now, all of that also depends on technical expertise, and that is where I would like to conclude with what the IMF can actually do and how we can help. We can help you building capacity and keep up with the rapid change in the banking industry. We constantly engage on these issues as a participant in international bodies where we seek to provide a voice for all of our member countries. And we have worked with your governments for many, many years to provide assistance and advice across a range of economic policy issues. Financial sector development is an integral part of our work. Our policy analysis and advice now consistently and constantly focus on financial issues, including under the Financial Sector Assessment Program that many of you know or have experienced. Increasingly, this work also is taking on a regional profile, highlighted by the 2015 report on the opportunities and challenges for cross-border oversight presented by Pan-African Banking. Our regional centers across Africa deliver training and technical assistance related to consolidated and cross-border supervisions. Let me give you the four instances. Experts in banking supervision at Afritac East in Tanzania are working with member countries, particularly Kenya, to implement consolidated supervision. This includes organizing supervisory colleges to oversee banks with significant cross-border operations. Afritac West in Côte d'Ivoire is working with the WAMU region on a framework for introducing similar consolidated supervision. And here in Mauritius, Afritac South has provided technical assistance on supervisory colleges and crisis management groups, and on establishing cross-border information sharing and cooperation. The fund is also launching a new capacity development instrument to support financial stability and inclusion in the region. And on that note, I would just also like to highlight for you the fact that it is in the African region that we have the highest number of officials who actually take our MOOC courses and qualify and graduate under such MOOC courses. Those are courses that are online, that provide completely qualifying diplomas to your officials, and they touch on different areas of technical expertise that can be put to good use in any country in the world, and at very limited cost. So in conclusion, the IMF strongly supports your effort to strengthen the environment for financial sector development in Africa. We believe that strong and sound Pan-African banks are a crucial part of this effort, that it's a significant opportunity for the region if it is well managed and mastered. And at the end of the day, we believe that both regulators and supervisors are key in order to provide actually such healthy financial sector. We believe that banks will provide the lifeblood of Africa's economic resurgence, and this will be not a short-term, not a medium-term, but a long-term effort. And the duty we have is obviously to keep abreast of significant changes that are taking place all over the world. Je pense qu'il y a un proverbe africain qui dit que quand la rivière sort de son lit, les crocodiles suivent. Alors je pense que quand la finance de temps en temps sort de son lit, ou que le lit devient plus grand, ou qu'il y a des petites ramifications, eh bien les crocodiles ont l'impératif non seulement de suivre, mais d'anticiper. Et vous êtes les excellents crocodiles nécessaires à la finance africaine et à la finance mondiale. Je vous remercie. So that you don't have to come back, I think we have a little coffee break now, so we can mingle for 20 minutes, is that right? We do everything at the IMF. So we have a coffee break and then we'll resume for the first panel. Thank you.